Let's get reaction from CNBC contributor David Zervos, chief market strategist at Jefferies. David, great to see you.
Good to see you, Melissa.
How do you examine this data? How does this change, if at all, your view of the Fed and what it does next year?
Well, first thing I'd say is all of this data has to be taken with a much larger grain of salt than we usually take it with. And that's a pretty large grain of salt to begin with, as the data consistently gets revised and certainly has been suspect for a number of years. We had 1.5 million job revisions in 2023 and 2024 lower. And as Chair Powell said in his press conference, he expects more revisions to the downside in this year. So I would say this is as noisy as it gets. But the trend, Melissa, is kind of consistent with what we've seen. Good growth data, not a lot of jobs coming from that growth data, lots of productivity growth, and real wages rising, which is good, but not rising fast enough to get the Fed nervous.
You're constructive on equities, no surprise, going into next year. And part of that is the Goldilocks scenario. But I really wanted to focus also on what was not called QE, but is de facto QE in terms of the asset purchases the Fed announced on the shorter end of the yield curve. How do these two play into, with each other to create that sort of constructive backdrop that you see?
Well, Melissa, we've been living in this QE world since 2009. The Fed has almost always tried to push aside these ideas that it is a monetary policy tool. They've tried to use it as a surrogate in times of stress, but then downplay it as much as they can in times of strength. The reality is when the Fed does QE, they add liquidity to the system, they monetize debt, and that is something that the markets, the risk asset markets, key off of. And I think the risk asset markets are keying off of these reserve management purchases, the RMPs as they call them. I like to call them ramps, reserve asset management purchases, because it sounds like what they're going to do to equities going into next year. But I think it's important to always take the Fed's storyline with the balance sheet a little bit, just downplay what they're saying, because I think they're hiding a little bit of what the balance sheet really does. And it does a lot and has done a lot. And I think it will continue to do a lot. And this is actually probably one of the more important parts of why the market reacted so positively to last Wednesday's FOMC meeting.
David, I'm curious your thoughts about this. Historically, markets love to challenge a new Fed chair. If you go back in time, you can see, and we're going to have a new one in May, and it's going to be under a much different backdrop than we've historically seen. Do you anticipate something like that happening?
I do, actually. I think you're exactly right. When Alan Greenspan came in, I believe it was in September of 87 or August of 87. I can't remember. It was October when we had a pretty big test. So absolutely, yes, we will test him or her in the new job. And we've done that. We tested Bernanke. We tested Janet Yellen. We tested Jay Powell. Certainly in 2018, he got some testing. It was a little later. But they always get their sea legs, and the markets sort of learn how to deal with them. And we move on and we move forward. I don't know how big this one is going to be, but I would definitely be playing for some test in terms of the short term.
In terms of your bullishness, David, though, when does this mostly unfold? Is this a back-end loaded kind of year that we're looking at?
It's hard to say. We could come out of the gates doing pretty well. The growth data looks strong. The economic data overall for GDP and the like continues to be unbelievably impressive. We just had 2 consecutive quarters of 4% growth without creating hardly any new jobs. There is a productivity story here, and it's been brewing for almost 3 years now, that suggests we are really in that more Goldilocks 90s style economy. And the equity markets are going to continue to price that in a more positive way. The question is what kind of stumbles we get. Will there be thoughts on the next Fed chair? Will there be, the committee going through some machinations with the Lisa Cook trial? There's all sorts of things to play with there, but there's a lot of good news. We've got oil prices at, I think, 4 or 5 year lows. I mean, sort of rates look like they're headed down, and hopefully we'll get those lower mortgage rates coming through. All of this sort of supports everything in the bullish camp. I think the real question is, what's that transition around the Fed? How does the credibility of the new makeup of the Fed transmit itself into risk assets? And there could be some bumps, but I think it's really hard to tell whether they come early or late. I think we are going to end up with a more dovish Fed, and ultimately a more dovish Fed is bullish for risk assets.